Hey Bowtie Nation, Joseph Hogue here, and a quick informal video for you today on some news out recently, and I hate to say this, but how Vanguard Funds just screwed its investors. Now let me be clear, before the Vanguard Love Fest starts trolling the comments, I have been one of the most vocal proponents of Vanguard ETFs and their index funds in the past. They're some of the best funds and the lowest cost options, and I will continue to recommend Vanguard, but it majorly dropped the ball lately, costing investors millions of dollars, and it demonstrates one of the most important investing strategies you need to be using. I'll start off by updating you on what happened, why investors are now getting the shaft from Vanguard Funds, and what it means for your portfolio, how to keep it from happening to you. Before we get started though, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now first, I've got to give credit to Jason Zweig of the Wall Street Journal for reporting on this first. All you value investors out there, Jason's name should sound familiar because since 2006, he's updated The Intelligent Investor, really the Bible for value investors, with his own unique commentary. I want to show you what happened here first, why Vanguard investors are getting hit with a massive tax bill, and then how to avoid falling into this same trap. The problem happened in their Vanguard Target Date Retirement funds, or really the 2035 fund, ticker VTTHX, and the Vanguard Target Date 2040 Fund, ticker VFORX. And these target date mutual funds are portfolios of stocks and bonds managed by Vanguard and automatically adjusted as you get closer to that target date. For example, right now, the 2035 fund has 74% of its assets in stocks, since investors still have nearly 15 years before retiring. But as each year passes, that fund is going to sell some stocks and buy more bonds. Now, this should have the effect of lowering that risk to make sure that money is there when those investors need it, but benefits from those higher stock returns until then. And normally, these funds are sold by advisors and targeted to retirement account customers for their 401ks and IRAs, but there are investors holding these in regular taxable accounts. The Vanguard 2035 fund has done really well, up 17% annualized in the past 3 years and up 11% a year over the last decade. And not as well as stocks, of course, but a good return on that lower risk because of the bond exposure. But now the problem started from a special deal that Vanguard gives large money managers, institutional clients that regular Main Street investors just don't get. And these big money institutions get a different version of the fund with lower fees and some other extra perks. Well, at the end of 2020, Vanguard reduced the minimum investment for institutional clients to just $5 million from $100 million previously in those target date funds. That cost billions of dollars of institutional money to sell out of the regular fund to put that money into the institutional version. In fact, more than $8 billion was withdrawn from that Vanguard 2035 fund. Now, when all that money comes out of a fund all at once, when the fund manager at Vanguard has to redeem that cash, he has to sell those stocks in the fund. And since the stocks had been held for years, there was a huge price difference, millions in capital gains that the fund had to report and distribute to shareholders. Now, to understand why they do this, mutual fund earnings are taxed at a higher rate than most investors. So instead, when they do sell stocks and book those returns, they distribute that money to the investors. You still have the same number of shares and receive that cash distribution whether you sell the shares or not during the year. So here, after this sweetened deal that Vanguard gave its big money clients, it forced it to sell those stocks in the target date fund and book the gains that had been sitting on those stocks for years. Now, that triggered this distribution event that went out to investors and that surprise tax bill. And you can see the effect of this. This is the distribution report on that Vanguard 2035 target date fund, and you see here in prior years, it was really negligible. At the end of 2020, the fund distributed just 40 cents in dividends and 22 cents as short-term and long-term capital gains per share. Even at that highest tax bracket, that's not going to be a tax hit that you can't handle. But look at what happened last year. At the end of 2021, Vanguard reported distributions of 56 cents in dividends and over $4.10 per share in capital gains that investors would now have to pay taxes on. To put this into perspective, if you had $100,000 in the fund at the end of 2020, you would have had about 3,970 shares and would have received distributions of $262 in short-term gains and $614 in long-term gains. Now, even at that 20% tax rate, that would have been a tax bill of just $175, so nothing anyone couldn't manage. But then what happened in 2021? On those same 3,970 shares, you would have gotten a distribution of over $16,000 for a tax bill of more than $3,250. Now, if the fund was in your retirement account, it wouldn't matter. You do not pay taxes on income or distributions in a 401k or IRA until you withdraw that money. But if that Vanguard fund was in a regular taxable account, which it was for a lot of investors, you'd be looking at thousands of dollars in taxes whether you sold shares or not. Naturally, investors were livid in the online forums, with one saying, "I think I'm screwed by Vanguard in an enormous tax bill. I feel like Vanguard guided me down this path, which is so frustrating." Now, to be fair to Vanguard, this can happen in any fund, especially in mutual funds. Where Vanguard dropped the ball is by not warning investors that this was going to happen and giving them a chance to do some planning around it. But it can happen in any fund, and it demonstrates one of the most important investing strategies you need to know, one we've talked about here on the channel before. Nation, any investment you make that is going to pay out dividends or distributions, it needs to go in your retirement accounts, either a 401k or your IRAs or any of those special tax-deferred accounts. Now, by doing this, instead of paying taxes on dividends or the distributions every single year, you get to reinvest all that money. You never owe taxes on any kind of income distribution in your retirement accounts until you withdraw that money in retirement. That can mean decades where the money you would have lost to taxes is earning a return, compounding that interest. Now, for those Vanguard Target Date Fund investors, had the fund been in a retirement account, none of this would have mattered. That nearly $5 a share that was distributed and taxed would have went straight into an account. They could have reinvested all of it and watched it grow instead of sending 15 or 20% to Uncle Sam. So again, if you have high dividend yield investments or funds like this that are going to pay out that annual distribution, these need to go in your retirement accounts. Now, you are limited to how much you can put into these accounts each year, so you need to prioritize those highest yielding investments here. For example, let's say you invest $4,000 in each of 3 funds. The Vanguard Growth Index ETF, ticker VUG, invests in growth stocks and pays a 0.57% dividend yield. The Vanguard Dividend Appreciation Fund, ticker VIG, invests in stocks of companies that have increased their dividends and pays a 1.5% yield. And the Vanguard Managed Allocation Fund, ticker VPGDX. This is a portfolio fund with stocks, bonds, and commodities and pays a 4% annual yield. Now, you're limited to contributing just $6,000 a year into your IRA, but you've got $12,000 of income-paying funds here, and you don't want to lose those to taxes. So what do? Here you would invest the entire $4,000 of that managed allocation fund into the IRA because that's paying the highest yield. If this money were in a regular taxable account, you would lose part of that 4% dividend yield every single year. But now you've got just $2,000 left you can invest in your IRA. Now, obviously, here you would want to do it with the Vanguard Dividend Fund because that's paying that higher income. In fact, the Growth Fund really doesn't pay much of a yield at all, so you're not too worried about taxes on that anyway. Most of the returns are going to be from capital gains. But you would want to break up that $4,000 invested in the dividend fund, $2,000 into your IRA, and $2,000 into a regular investing account. And here is what just that simple strategy does for your money. If you were to hold all 3 of these investments in a regular investing account, you would owe $49 a year in taxes on those dividends you collect. That's at that 20% capital gains rate, and it may not seem like much, but investing another $12,000 each year and paying this over 30 years, that's over $22,000 you would lose to taxes, and it doesn't include the money that you would have made off of that amount. But if you were to split that up, like in our example, with the high yield fund and part of your dividend fund in the IRA, you'd save nearly $40 a year and thousands over a lifetime of investing. You pay less than $5,000 in taxes while you're investing, and your tax rate is likely to be lower in retirement, so the money from your retirement investments comes to you with less taxes owed. Click on the video to the right for the 10 ETFs investors are buying. 10 exchange-traded funds investors put almost $1 trillion in just last year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.